This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, August 14, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is staring down the barrel of its own ceiling. With SPY trading at $777.88, we are less than $2 away from the August 13 high of $779.37. Meanwhile, the NASDAQ 100 is pushing even harder against its 5-day high of $733.96, at current levels of $732.07. But here is the catch. The VIX is compressing to a low of 14.55, signaling a complacency that might be hiding a structural crack in the foundation. Let's see if this rally has room to breathe or if it's running out of gas. Before the bell rings, let's look at the schedule. Today, Friday, August 14, brings retail sales data and business inventories. These are the immediate flashpoints for gauging consumer resilience. Looking ahead, Monday brings the Empire State Manufacturing Survey. In the meantime, the market is digesting yesterday's initial jobless claims and PPI data. Apex, where is the focus?
The focus is on whether the retail sales data can validate the soft landing narrative that is currently propping up the QQQ. If consumer spending holds, it supports the tech-heavy rally. If it stumbles, it exposes the fragility we've been discussing regarding the flat yield curve.
Let's set the scene. The NASDAQ 100 ETF, QQQ, is leading the charge with a plus 1.16% gain, trading at $732.07, approaching its high of $733.96. The S&P 500, SPY, is up plus 0.7% at $777.88, testing the $779.37 resistance. But the Dow Diamonds is barely moving at plus 0.14%, $537.91, and the Russell 2000, IWM, is lagging at plus 0.26%, $303.50. Grid, what does the tape tell us about this divergence?
It tells me we are in a narrow, high-stakes corridor. Look at the QQQ structure. It closed Friday at $732.07, which is essentially hugging the $733.96 resistance level. That is a 0.2% distance. On the SPY side, we are $1.49 away from the $779.37 high. The issue is breadth. You have the technology sector, technology, up plus 1.1% today and plus 2.94% for the week, while the industrial sector, industrials, is down minus 0.5% and the materials sector, materials, is down minus 0.51%. The rally is not broad, it is a wall of money propelling just one sector.
And that concentration is driving specific movers. Let's talk about the catalyst. Western Digital, WDC, is gapping up plus 4.5% to $509, and Micron MU is rising plus 3.6% to $984.31. This is being driven by Kospi sentiment, but it stands in stark contrast to Applied Materials, AMAT, which is down minus 6.4% despite a strong margin streak. SPECTER, what is the risk angle here?
The risk is fragmentation. You have WDC and MU pumping on external Korean market cues, but the broader semiconductor infrastructure play, represented by AMAT, is getting sold off aggressively. This isn't a sector-wide rally, it's a disjointed flow. When you see a plus 348% volume anomaly in XHG and a minus 95% crash in F&GA alongside these moves, you are seeing speculative chaos, not institutional conviction. The VIX at 14.55 is suppressing the noise, but the underlying structure is noisy.
So we have a tech vs. value bifurcation. The technology sector and communication services, plus 2.7% are leading, while traditional value sectors like the financial sector, plus 0.59%, and the utilities sector, plus 0.46%, are just treading water. CIPHER, what are the flows telling us about this rotation?
The flows are confirming a growth over value bias, but with a caveat. The bullish sentiment is concentrated in AI and financial proxies. NVDA has a plus 0.39 sentiment score. Coin is plus 0.78. However, the core hardware stalwarts are struggling. Apple is at 0.14 sentiment. AMD is neutral at 0. This suggests that while the story of AI is still attracting capital, the actual earnings power of the broader chip supply chain is facing skepticism. The WDC/MU surge is narrative-driven, not necessarily fundamental.
Let's dig into the triple Q. It's at $732.07, just shy of $733.96. Grid, you mentioned the 5-day high. What happens if we hit that level?
If we hit $733.96, we are at a structural ceiling. The accumulation has been aggressive into that close, but without a break above $733.96 on higher volume, this becomes a Friday fade candidate. The support is at $724.03, so if we get rejected hard, we look at a return to that lower bound. The problem is the lack of follow-through in the IWM. If the small caps don't join, the triple Q is standing on one leg.
I agree with the fragility of the leg. The VIX is at 14.55. That is maximum complacency. When volatility is that low, you don't get gradual corrections, you get snapbacks. The sentiment divergence I'm seeing is key. NVDA and GS are strong, but Apple is weak. The crowd is chasing the AI narrative but abandoning the broader tech stack. That's a fatigue signal.
And that fatigue is visible in the options flow. The put/call skew is flattening because traders aren't hedging against a downside break, they are expecting the breakout. But CIPHER here notes that the WDC/MU move is isolated. If the broader semiconductor complex, like AMAT, keeps rejecting gains, the triple Q's reliance on NVDA becomes a bottleneck. We need breadth to sustain a break above $733.96.
Which brings me back to the yield curve. The 10-year 2-year spread is flat at plus 0.48 pp. You are trying to force a breakout in triple Q while the bond market is signaling a slowdown. The VIX at 14.55 is not just complacency, it's a mispricing of risk. If that $733.96 level holds firm, and the broader market diamonds at $537.91, refuses to participate, the unwind will be violent because nobody is hedged.
So the consensus is narrow, fragile, and reliant on NVDA. Let's pivot to SPY. It's at $777.88, touching $779.37. Grid, is this a breakout zone or a trap?
It's a trap until proven otherwise. SPY is testing the upper bound of its recent range. The high of $779.37 was established on August 13. Retesting it without new catalysts usually results in rejection. The support at $774.11 is solid. But the path of least resistance right now looks like a consolidation or pullback if we fail to close above $779.37. The volume profile doesn't suggest a breakout impulse, it suggests distribution.
Distribution is the right word. The inflows are concentrated in consumer discretionary, plus 0.48%, and the technology sector, but the energy sector, energy, is up only plus 0.5% despite a strong weekly trend. That lagging indicator effect means the rotation into energy hasn't started yet. If SPY rejects $779.37, the money might rotate out of the overheated tech and into defensive plays, but currently, the defensive sectors like consumer staples, plus 1.8%, are just quietly climbing, not leading.
Let's zoom in on the semiconductor complexity. WDC is up plus 4.5% to $509. MU is up plus 3.6% to $984.31, but AMAT is down minus 6.4% to roughly $190 range. implied by sector context, though exact last price not in table, we track the movement. CIPHER, how do we reconcile these opposing forces?
We call it narrative decoupling. WDC and MU are reacting to the Kospi returning to a bull market and specific storage demand cycles. It's a subsector tailwind. AMAT, however, is facing headwinds from equipment capex scrutiny. Even with 13 consecutive quarters of margin expansion, the market is selling it. This tells me that good earnings aren't enough anymore. The bar for acceptance has risen. The sentiment score for AMD is 0, and Apple is negative. The halo effect from NVDA is not spreading to the whole chain.
And that's why the sentiment bifurcation is dangerous. The AI trade is bifurcating. You have the enablers, NVDA, coin going parabolic, and the legacy hardware players stagnating. The crowd is rotating within the sector, not expanding into it. That internal friction reduces the momentum capacity of the QQQ as a whole.
Technically, that friction shows up as resistance wicks. If you look at the intraday ranges, MU is pushing toward $984.31, but if it fails to hold above its opening levels, it drags the technology sector index down. The technology sector is up plus 1.1%, but that average hides the dispersion. You have winners at plus 4.5% and losers at minus 6.4%. That variance is a warning sign for trend sustainability.
The warning sign is the VIX. As long as the VIX stays at 14.55, the market ignores the AMAT weakness. But once that number ticks above 15, which is the threshold mentioned in the data, the repricing of the semiconductor complex will accelerate downward. The low vol environment is masking the fundamental disagreement between the storage narrative and the broader chip outlook.
Finally, let's look at the laggards. IWM is at $303.50, up just plus 0.26%. The 10-day high is $305.05. Why is the Russell 2000 left behind?
Because the cost of capital is still high. The 2-year Treasury is at 4.2% and the 10-year at 4.68%. Small caps are more sensitive to those rates. They don't have the cash piles of the mega caps in the QQQ. So when the market is risk-on, it buys the quality large caps. When the market gets scared, it abandons the small caps first. Here the market is cautiously optimistic, so small caps get ignored.
There's also a liquidity preference. Institutions are parking money in the NVDA/MSFT ecosystem because it's liquid and safe. The micro-cap anomalies we saw earlier, XHG up 348%, FNGAR down 95%, show that retail money is gambling in the corners, but institutional money is staying in the blue chips. Until we see institutional volume flow into the IWM, this breadth gap won't close.
Correct. The fear and greed dynamic is skewed. The VIX is low, but the put/call ratio isn't showing the speculative fervor needed for a broad rally. It's a quiet rally. Quiet rallies tend to die quietly unless a major catalyst like the retail sales data comes in hot and validates the consumer spend.
Or collapses loudly. If retail sales disappoint, the stagflationary risk, the mix of 1.5% GDP growth and 3.29% core PCE, will hit the small caps hardest. They have no pricing power. IWM at $303.50 is dangerously close to the psychological level of $300. A break below $302.72, yesterday's low, would trigger automated selling.
Apex, tie it together. Grid flagged the technical resistance at $733.96 for QQQ and $779.37 for SPY. CIPHER pointed out the flow concentration in NVDA vs. the weakness in AMD/APL. How do these pieces fit?
They confirm a fragile leadership model. Grid observation that QQQ is within 0.2% of its 5-day high highlights the technical pinch point. CIPHER data on sentiment divergence, strong AI proxies versus weak legacy tech, explains why that pinch point is vulnerable. The market is betting on a soft landing, supported by the low VIX of 14.55, but the fundamentals, flat yield curve, cooling payrolls, are pulling the rug. The synthesis is that without a broadening participation from sectors like the industrial sector or IWM, the current technical levels are likely to act as ceilings rather than floors. The risk is not a slow grind, but a sudden re-evaluation of the perfect setup.
Here is the takeaway. The S&P 500 is testing $779.37, and the Nasdaq is knocking on $733.96. Both levels require volume and breadth to break, and right now, the breadth is missing. The VIX at 14.55 suggests calm, but the calm is deceptive. Tomorrow, watch the retail sales data. If it misses, the soft landing narrative fractures. If it beats, the tech-heavy rally might extend, but likely without the small caps joining in. Stay sharp, manage your risk, and respect the resistance levels. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.